All right, welcome to the Explainer. Today we're looking at a market that really feels like it has a split personality. I mean, on one side, you've got this glimmer of hope, politically speaking, but on the other, a total bloodbath in tech and some pretty shaky economic signs. So let's jump into the numbers from November 7th, 2025, and see if we can figure out what's really going on.
And this really is the perfect picture of that conflict, isn't it? It's a classic tug of war. You've got the bulls over here, and they're pulling hard, right? They're hearing these whispers late in the day about a potential deal to end the government shutdown, and they're thinking, okay, recovery time. But then you've got the bears, and man, they have a death grip on the other end of the rope. Why? Because some of the biggest names in tech, the absolute giants that have basically carried this market all year, just got hammered.
So the final numbers, they really tell a tale of two different markets. I mean, look at this. The S&P and the Dow, they just barely squeaked into the green for the day. But the Nasdaq? Nope, couldn't escape the red. Now, if you zoom out and look at the whole week, that's when the picture gets really ugly. Just look at that difference. The Nasdaq is down more than 4%. We're not just talking about a little dip here, folks. This is a big deal, a major correction that's starting to cast a long shadow over everything.
Okay, so let's really dive into that. Let's pull back the curtain on the tech sector, because honestly, it's the main culprit for all the anxiety we saw this week. So what on earth happened to the darlings of Wall Street?
Wow, yeah, that's the number. A drop of 4.43% for the Nasdaq in just 1 week. That's the worst we've seen since back in April, and it sent absolute shockwaves through the market. I mean, think about it. After this incredible run all year, suddenly investors are slamming on the brakes, and they're starting to ask some really tough questions. Are these tech stocks just way too expensive? Are companies pouring billions into AI without seeing the profits? Is the big AI party finally over?
And this wasn't just one company having a bad day. Not at all. The pain was spread all over the place. You had some of the old guard, Oracle, AMD, they took a serious hit. Even Tesla got caught in the downdraft. And then it was like a domino effect of bad news, one after another. Microchip comes out with a weak forecast. Block misses on its profits. Take-Two has to delay a huge game release. It was just boom, 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 a total sector-wide reality check.
So the big question is, right, is it time to panic? Should you be selling everything? Well, not so fast. There's some analysts out there like Leah Bennett who are actually saying, hey, calm down. This isn't a crash, it's a healthy correction. The idea here is that the market got a little too excited about AI, creating this huge hype bubble. And now it's just letting a little air out. It's that classic short-term pain for long-term gain kind of thinking, setting things up for a stronger rally later on.
But here's the thing. This whole tech mess, it isn't happening in a vacuum. It's happening at the same time we're getting some pretty unsettling data about the broader economy. And it feels like no matter where you look, all roads lead right back to the gridlock we're seeing in Washington.
And this chart right here, it just perfectly captures the mood out there on Main Street. We're talking about consumer sentiment. And look, it didn't just dip a little, it absolutely plummeted, way below what everyone was expecting, down to almost historic lows. And a lot of that is because of the government shutdown and this general feeling of dread about the economy. And you know what they say? When the consumer gets nervous, the whole economy gets a cold.
But okay, if you thought that was bad, here's the number that's really got people worried. This is a huge red flag for the job market, which, let's be honest, has been the one really strong pillar holding up the economy. So what exactly just hit a 22-year high?
Layoffs. That's right, layoffs. Job cuts in October just soared to the highest level we've seen in more than 20 years. And this isn't just some abstract statistic, right? This is a sign that the economic slowdown is really starting to hit people at home. And to make everything even more confusing, the shutdown means we don't even have the official jobs report. So investors are basically flying blind, trying to figure out how healthy the labor market actually is.
All right, so let's zoom out for a second. Let's look at the global picture, because there's a whole other set of risks brewing out there. And in the world we live in today, something that happens in Kyiv or Beijing can hit Wall Street in an instant.
So this table kind of lays out the global minefield that investors are trying to walk through right now. You look at Ukraine and these strikes on Russian refineries, that's adding what they call a risk premium to oil prices. Basically, it means we're all paying a little more for gas because of a conflict. Then you've got Beijing making a small move on rare earth licensing, which is, okay, a tiny step in the right direction for US-China tensions. But let's be real, that trade situation is far from over. And all of this is going on while the US is dealing with its own massive debt and shutdown drama. It really is a perfect storm of uncertainty.
So, with all this chaos swirling around, where do you put your money? Where do investors go to hide?
Well, they run to the oldest safe haven in the book, gold. The price shot up as everyone was looking for some shelter from the storm. It's a classic move anytime the market gets this choppy.
And at the exact same time, look at oil prices. They're creeping up too. Remember that risk premium we just talked about? Well, that's what's keeping prices high. And you have to think of that as basically a tax on the entire global economy. When energy costs more, it can kickstart inflation and slow down growth. It's just one more thing for investors to worry about.
Okay, so let's recap. We've got a massive tech sell-off. We've got a super nervous consumer. We've got global tensions and political gridlock at home. So the big question is, what do you do? How do you possibly invest in a market like this? Well, let's break down the playbook. All right, here's the game plan straight from the pros. Step 1, play defense. This might be the time to look at moving some cash out of those high-flying, super expensive tech stocks and into sectors that are more about value, like financials or energy. Step 2, hedge your bets. Think about adding some gold and silver to your portfolio. They can act like an insurance policy when the market gets volatile. Step 3, you've got to keep your eyes peeled. Glued to the news out of DC. What happens with the shutdown, what the Fed says about interest rates, that is going to be absolutely critical. And finally, number 4, just maintain your balance. Things like bonds can be a really steady anchor for your portfolio when you're sailing through choppy waters like these.
And so that leaves us with the million-dollar question, doesn't it? Is what we're seeing just a healthy correction, a quick pause to catch our breath before the next big rally? Or are these the first tremors of a much bigger earthquake to come? The market is standing at a crossroads, and honestly, the direction it chooses in the next few weeks could define the rest of the year.